Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra, and with me somebody very, very special joining right in. Mr. Ruchit Mehta joins in. He's the head of research at SBI Mutual Fund. Welcome to Business Today TV, sir. Thank you so much for talking to us. First up, I wanted to understand your own sense about the Indian markets over the next 6 months or so. Why I'm asking this is because a lot of changes are happening, of course, because of the state elections, then general elections, the budget will be coming. We've seen the markets touch the peak of 20,000, 2022. But what about now? I mean, are you going to see a period of rise, or is there going to be extreme volatility? How do you see the markets?
I think the next few months can be volatile, particularly heading into the election cycle. I think what will be crucial is to see around the February-March period when you will start to see a lot of the opinion polls come out, which will kind of show kind of the direction in which the general elections could play out. And I think markets will start to take a cue from there. So it will be a volatile period, and I think investors should be cautious of that. Budget unlikely to have a major impact, and we've seen that over the last few years that incrementally the budget has stopped making any material impact on markets. Because the style of the government, especially this government, has been to do more things outside of the budget, announce more policies, more fundamentally different things or things that can impact the market outside of the budget itself.
Yes.
So I think the budget is more like a statement of fact, and particularly this year, coming year, because it's more going to be a sort of a vote on account, right? So it won't really matter much.
Won't really matter much. But then where do you see the Nifty, say, over a period of 12 to 18 months from here, sir?
So I think the Nifty per se looks very interesting to us because it represents a large cap. And we've been a lot more inclined to the large cap universe at this point, especially given the way mid caps and more so small caps have done. I think the rally in the mid and small cap has been very, very sharp. Particularly the smaller the company is, the more the rise has been, which has made us a lot more cautious on those names. So I think the Nifty could see a decent move from here. I mean, generally, should an investor expect 10-12% gains in the Nifty? Possible. So I would be more positive on the Nifty per se.
Okay.
And in some senses, this year also, right, YTD Nifty is up just about 5%
Sure.
And that kind of has been reflecting, one, the sort of weakness in the global markets, the rise in interest rates, etc., and some of the largest companies, particularly let's say IT, etc., which have faced a bit of a tough time. But as things change, I think the large cap looks very, very promising.
But how do you see the valuations of the Indian markets right now? Are there any pockets of overvalue that you see in the Indian markets?
Oh, there have always been pockets of overvaluation, right? And it kind of boils down more to sector specific.
Yes.
And sometimes more than the sector, is actually boiling more down to individual companies per se. Right now, I think the highest degree of overvaluation is on the small cap side of it. There are a lot of companies in the 30, 40, 50 P multiple ranges. The broader markets are at about 20, 22 times, I mean, depending on what estimate you take. So I think the Nifty is about 21, 22 times on a 1 year forward basis. So it's kind of okay. It's still a little more expensive than its own history. But if earnings growth remains strong, and first half earnings growth has been about 25% for the Nifty, then I think we are okay on the Nifty side of it. But yeah, the small cap is again where the highest pocket of excessive valuations are.
So where would you incrementally now be deploying your funds, sir? Say over the next 6 months, where exactly would you be putting in fresh money?
So our investments go a function of the category of the fund that money is flowing into. What we are recommending to our investors is to do a combination of either hybrid funds, where there is a good balance between equity and debt, and particularly in categories such as Balance Advantage, which can dynamically allocate the equity corpus, all the multi-asset funds where gold is a component of that product. And we are telling investors to say look at the large cap and the large and mid cap space. Because I think, as I said, valuations there are a lot more attractive, and earnings growth is pretty solid.
Okay. So if I have to ask you for, perspective of a fresh first-time investor, if a first-time investor has 10 lakh rupees, how would you ask them to really deploy those funds across market caps, across asset classes as well, if somebody has to deploy that 10 lakhs?
I think the question is a function of what is the profile of the customer.
Yeah.
Let's say if you're a young guy starting your first job, your first investment, let's say you're below 30s,
Yeah.
in your 20s. I think you just do a combination of focused funds and small cap and mid cap funds, because I would recommend that person looks at a 25, 30 year time horizon of investing. If you're somebody who's in your 50s and you're investing for the first time today, then I would really recommend them to look at hybrid funds.
Okay.
And start off with more the conservative, such as either a conservative hybrid or an equity savings kind of a product, because the risk tolerance generally can be lower when you're investing for the first time at a later stage of life.
That's true. Okay, also help me understand, say for example, over the next 2 or 3 years, which are the key themes that you believe will emerge as mega trends in the markets?
More than megatrends, I think there are 3 broad areas that as a house we've been positive on. So one is financials,
Okay.
because the sector is seeing very good quality on their earnings side, as well as very strong balance sheets as well. So I think financials looks very interesting. Growth has been good, earnings have been strong, and balance sheets are, as I said, have been pretty solid, because a lot of the NPMS is behind them.
Yes.
The second is the industrial engineering capital goods sector. I think we are seeing a good turnaround on the investment side of it. After almost a decade of underinvestment. So I think there is a lot of potential there. So while earnings growth there can likely be strong, I think valuations have gone a little bit ahead right now. The other area is discretionary consumption. So be it airlines, hotels, travel tourism. So all that whole basket of discretionary consumption, automotive for example, is something that we like.
Sure. But are there also any sectors, say for example, you'll now ask investors to stay away from, stay clear from? You've seen a lot of runaway sectors like defense, PSU for example, after a long period of underperformance, they've suddenly shot up so sharply. Railways for example as well. How would you be really looking at these stories?
Well, these are all very small micro sectors, right? I think railways as a sector or defense, I mean, it's not materially large, so that one takes a very active call on it. I think there you go very stock specific. Though yes, a lot of them are on the smaller cap side, so therefore they've seen a very sharp rise in their valuations.
Yeah.
So companies have to now deliver significantly better earnings growth for the stock prices to sustain themselves. So I think there is a good element of risk out there. IT we've been underweight for some time. I think it's an externally facing sector. There are a lot of headwinds out there. But I think it will take another 6-9 months for IT to kind of recover. So that's been one sector that we've been underweight at this point.
Okay, IPOs I wanted to ask you on. A lot of IPOs have been coming. Perhaps this year we've seen considerably good IPOs as well come out. And of course the new age internet companies as well, because they've started to perform well, fundamentally as well. Profitability is finally being shown up. How would you be looking at these two spaces, and what would you advise?
So we look at a lot of companies that are coming up for public listing. There are some interesting areas that are coming up, some really fine companies that are coming up. But by and large, we see that not everything is investable. And not everything that we like is at a price that we like it. So as a house, we've been more on the side of rejecting ideas rather than sort of investing in it. So we've been very selective in our IPO investments.
Okay.
And on the new age side, see, there are some interesting areas of new technology. I think we when we look at those companies, obviously one is to have a longer term horizon of investing in them. But what we really are looking at it, that what is unique in their business model, right? Why is this a differentiated company? And then even if you're investing today and you're making losses, right? We want to understand what's the path to profitability. I mean, have you started with a model which assumes a certain level of revenue and profitability, or are you just just garnering sales for the heck of it, right? Then that's never going to be a business model that'll be profitable. So we like some of the names in that area also, but we again just be a lot more selective.
Okay. Last question to you would be, sir, like a lot of investors also have this FOMO nowadays, fear of missing out. Say we've already seen a peak in this year, obviously. But do you think that investors thinking that already the markets have become so expensive, should I invest right now or not? What would you tell them?
I think investors always have a fear of FOMO when markets are doing well. I think, but one should not fall prey to that.
Okay.
I think, if you create a systematic investment plan for yourself, which is investing over a longer duration, at least 5-7 years, then it doesn't matter what the market levels are, right? So because longer term markets eventually keep going higher is as the economy grows, as earnings keep coming. So don't get in the trap of FOMO.
Okay.
But invest for the longer term. Invest from a 10, 15, 20-year perspective.
All right. Well, on that note, thank you so much, sir, for speaking to us and sharing all that valuable insight with all our viewers. Thank you so much.
Thank you.
If you like the video, do like, comment, share and subscribe.